Last week was another brutal one for Chinese equities. The Shanghai composite index fell a further 7.6% to its lowest level in 4 years. Foreign investors, who increased their holdings of onshore stocks following their inclusion in benchmark indices, are turning bearish. They sold $2.4 billion of yuan-denominated shares last week through the trading link with Hong Kong, according to data from Bloomberg. Yet China's battered stock market has only been a sideshow for international investors in the past week. Instead, all eyes have been on the dramatic sell-off in U.S. equities, this year's most popular and resilient asset class. The decline in U.S. shares was so ferocious, the tech-heavy Nasdaq Composite Index suffered its worst rout since 2011. That a gauge of global equities outside the U.S. fell to its lowest level since April 2017. Yes. It is doubly significant because of the importance Trump has attached to the performance of the index since he took office. Not only does he frequently take credit for the Trump's hatred of California may crush its advantages over China's stock markets have been on Trump's side, as I explained in an earlier column, with U.S. leadership in equities becoming much more pronounced this year. Yet last week's sell-off came as the America First trade policy lost a little momentum. Although this can be attributed to a number of factors, from the recent increase in U.S. bond yields to more attractive stock valuations in other regions, the fallout from the escalating trade war cannot be discounted. A more vulnerable U.S. equity market raises the stakes for the Trump administration, particularly given mounting market anxiety over the renewed decline in the yuan. The Chinese currency fell to 6.92 on Friday after the People's Bank of China set the weakest daily fixing since February. According to Bloomberg, speculative bets that the yuan will weaken past the psychological threshold of 7 per US dollar have risen to a new high since the Chinese currency began falling sharply in June. If the trade war deepens, Beijing could press home its advantage by allowing the yuan to depreciate more sharply, straining the Robin Brooks, chief economist at the Institute of International Finance, argues that Trump's use of the To be sure, Beijing would be letting the yuan slide at its own peril. Lessons to draw from the president's Fed comments. Rumors the Fed is shifting hawkish are an illusion. Well, get the dots at most, and this administration is very focused on SPX, an Achilles heel to U.S. policymaking, especially if China devalues more in the trade dispute. pic.twitter.com/5beacon3heb, Robin Brooks, at Robin Brooks Eve, October 11, 2018. A much weaker yuan could drag China back into 2015-16 territory, increasing the scope for a disorderly depreciation and capital flight that proved so damaging then. The Chinese currency is already a major focal point for market anxiety, and the Trump administration is weighing whether to label China a currency manipulator in a report due out this week. Yet a weaker yuan would be a logical response to more punitive tariffs on Chinese goods. Beijing has, for some time now, been signaling that it is not losing sleep over a further drop in the currency, partly because it has tightened capital controls. China's yuan more popular as reserve currency despite trade war. IMF data shows the recent shift to more growth-supportive policies makes a breach of the 7 per US dollar level more likely, especially if the greenback strengthens further. The challenge for Chinese policymakers is to convince markets that the pace of depreciation will remain orderly. Make no mistake, any China-induced fall in the but putting more pressure on the America First trade policy in the coming weeks and months is one way to make Trump think twice about slapping steeper tariffs on Chinese imports. Last week, he pinned the blame for the sell-off on an out-of-control Federal Reserve. He has been so sensitive about the direction of the stock market that Beijing may have more leverage than many think. Nicholas Spiro is a partner at Laressa Advisory.